Hello everyone, welcome to my channel. Today in this video, I am going to explain a very important topic from accounts, which is understanding liabilities in the company's final accounts. This is very important in finance. In this video, we will understand what are the liabilities, how they are classified, and we will specially focus on other long-term liabilities, long-term provisions, and short-term borrowings. So let us begin. So first of all, let us understand what does it mean by liabilities. Liabilities are the amount which company has to pay for the future. In simple words, liabilities are the debts and obligations from the businesses. Whenever a company receives any benefit like money, goods or services and payment is not made, it is called liability. A liability is created between company and the creditor or a bank. For example, if a company takes a loan from a bank or a creditor. Similarly, if salaries are payable to employees or goods are purchased on a credit, there are also liabilities. So, liabilities shows how much a company owes to others. So, let us classify what are the liabilities. Liabilities are classified based on time period within which they are payable. There are mainly two types of liabilities. First, long-term liabilities. Second, short-term liabilities. Long-term liabilities which are payable after 1 year. Short-term liabilities which are payable within 1 year. So this is classification is very important because it helps us users of financial statements to understand the company's financial stability. So let us move on to the next slide. Other long-term liabilities. Now let us understand what are the other long-term liabilities in detail. Other long-term liabilities are those liabilities which are payable after 12 months from the balance sheets. These balance sheets are important as these liabilities are different from regular long-term loans. For example, security deposit received by the company, deferred revenue, and long-term trade payables, which comes under this category. These liabilities are shown under non-current liabilities in the balance sheet of the company. This indicates long-term financial commitments of the businesses. Now, let us move to the next slide. Long-term provisions. A provision is an amount set aside to meet a future expense or losses where the exact amount is not known. Provisions are created to follow the principle of prudence in the accounting. When such provisions are payable after 1 year, they are called long-term provisions. Means these provisions are paid after 1 year. So after 1 year, it is called as a long-term provisions. Common examples include provisions for gratuity and provisions for employee benefits. These provisions helps company to prepare for future obligations. Now next us to the next slide. Short-term borrowings. Now let us move to short-term borrowings. Short-term borrowings are the loans which is taken by the company to meet day-to-day working capital needs for the businesses. These borrowings are repayable within 12 months. Now, short-term borrowings are paid within 12 months of the provision from the balance sheet date. Examples of short-term borrowings include bank overdraft, cash credit, and short-term loans. These borrowings helps company to manage short-term financial requirements. Now let us move to the next slide. And this is the last slide and the conclusion. To conclude this topic, liabilities represent the obligations of the company. They are classified into long-term liabilities and short-term liabilities. Other long-term liabilities and long-term provisions are payable after 1 year, means which both are paid after 1 year, so it is called as a long-term liabilities. Short-term borrowings are payable within a year, means the company has to pay these dues within a year. Understanding liabilities helps in preparing and analyzing companies' final accounts. Thank you for watching.